China's power crunch has been roiling the global commodity space, affecting everything from oil and copper to soybean to nickel. Now, with U.S. inventories on the rise and an energy crisis raging in Europe, the equation is getting a bit more complicated by the day. We'll drill down on the sudden surge in oil prices and price pressure on industrial metals like copper and iron ore. How can investors play it best? Will, what do you think? How should investors be playing what's going on in commodities right now?
Well, it's a great question, and it really depends on what you're trying to do, because there are a multitude of ways you can play the commodity market. If you're looking just for broad exposure, the GraniteShares commodity ETF, COMB is the ticker. That's just a broad strategy, no K1, very low cost. But of course, there are other more specific investments like gold, for example, like oil. There are other ways that you can get much more specific in terms of targeting different commodities that you want exposure to. So whether you're worried specifically about energy, whether you're worried about food prices, whether you're worried just about inflation itself, there are ways you can find that in the ETF market.
Matt, you have Chamath Palihapitiya speaking at Delivering Alpha last week, and he said basically that Bitcoin is the new gold. Maybe not speaking specifically to crypto in and of itself, but how are you kind of thinking about the specific plays as we look ahead to the potential for more inflation? Or do you think that investors should stick with, what's traditionally been seen as a way to play inflation?
I mean, when it comes to inflation, rising commodity prices, my intuition is for investors to try not to be a hero. I think a lot of people have been burned in the past of trying to predict the path and pace of different commodity prices, particularly oil, which is so connected to different parts of the global economy, particularly what's going on in China, but also the reopening. I mean, you really have to have a steel stomach to be within the commodity space right now. And I think just don't try to be a hero. I mean, what's the derivative impact of some of these price pressures? We're likely to see higher inflation and higher CPI prints. Well, if you know that's sort of your base case, then why not just take a few basis points, own tips relative to nominals, and sort of continue a trade that has been working and has basically produced some really good returns when you think about what's going on in the fixed income market. So I think looking in the commodity space, my idea would don't be a hero. Don't try to sort of forecast the sort of unforecastable with so many unknowns in the marketplace. Try to eke out a couple basis points in your bond portfolio, which is really hard to do these days.
Absolutely.
Yeah,
Dave, do you agree with that?
Yeah, I understand what you're saying there, Matt, and I think you're right. I think this is not a market where people should be deciding they want to become energy investors all of a sudden and starting to learn about the crude market. I think a broad commodities baseline exposure, like Will's product, I think is a sensible way to think about inflation for a lot of investors. But what we're discovering here isn't so much that we have a supply shortage or a demand spike. What we're seeing is the interconnectedness of all of these markets, from the industrial metals to global manufacturing to crude oil to the coal situation in China. All of these things connect, and they're global, right? That's part of the problem, is that we've got local crises and we're trying to take global commodities to solve them. So it is a market that I think requires an iron stomach if you're trying to make individual calls. I think broad baseline exposure is the way to go.